I'm Martin Wolf. I'm here at the Ambrosetti Forum at the Villa d'Este in Como. And I'm here with Jean-Claude Trichet, former president of the European Central Bank. Monsieur Trichet, thank you very much for being with us.
It's a pleasure, Martin.
Let me start with the really quite fascinating and complex decisions that the European Central Bank has made last week, announced by Mr. Draghi. Do you think these measures will work?
I think they are going in the right direction, obviously. I don't think that any central bank can itself settle all problems of that kind, because we have a number of other partners that are at stake. But I would say on the side of the purchase of securities, the CBPP 3 comes after 1 and 2, which were taken under my own chairmanship. So it's the continuity, but it's good. It goes in the right direction. The ABS had been pre-announced, and it is the delivery of what had been pre-announced. The targeted LTRO also had been announced already. So all this is fully in the continuity of what had been announced and goes in the right direction, in my opinion. What was not announced was this last decrease of rates, which has the merit that it really demonstrates that nobody can say the ECB doesn't do what is necessary to augment as much as possible the interest rate differential with the UK, with the US. As you know, it's the case, of course, for the monetary policy, but it's also the case for the risk-free long-term interest rates, which are now at 140 basis points or even 145 basis points below the US in Europe, in the euro area. And Spain is borrowing now below the US, Italy also. So we are in a universe where obviously something has been done in terms of interest rate differential.
Do you think there's actually anything more that the European Central Bank can do? Is it actually really exhausted the realistic options given the political problems of doing a standard quantitative easing program, buying lots of government bonds?
In my time, as you know, nobody was expecting, and I was criticized heavily for that, because we purchased treasuries in May 10, and we purchased Spanish and Italian treasury in August 11, and it was an immense new, I would say, thing that was not foreseen in advance, of course. So never say never. But that being said, it seems to me that the market, when they are saying, why don't you do a full-fledged QE US-like, are totally forgetting that first, we have an insurance policy for all commercial banks in Europe that they can have all the liquidity they want without limit. They could have 1 trillion, 2 trillion, 3 trillion more. And that there is the OMT coming after the S&P, which gives an insurance policy for the treasuries themselves. So those two insurance policies are signaling something which does not exist in the US, does not exist in the other advanced economy, and to me is very much the equivalent of a quantitative easing, because again, no lack of liquidity is even thinkable in the area.
And long-term interest rates are already very low, as you say.
Yes, and some are already arguing that there is some kind of bubble in our long-term interest rates. So I think that concentrating on the private tradable securities, as is done, is very well in line with the need of Europe, and also will foster disintermediation, which is obviously necessary in Europe because we are financing too much the European economy through banks and not sufficiently through markets.
What is now really the task for governments?
First of all, governments have to deliver on what they have promised, because the market, the investors and savers the world over, are giving credit to Italy, to France, to the others, that they will deliver what they said in terms of structural reforms and also in terms of soundness of their fiscal policy. France would not have 100 basis points below the US if France had not said we will deliver, and the same for a number of other countries, including Italy. So that's very important. But of course, when you address the question of fiscal policies, you have three interlocutors. One are those who have problems, and my own understanding is that the Stability and Growth Pact has to be respected. Second, those who have room for maneuvering. And for those, it's absolutely clear that normal functioning of market economy should call for activation of the domestic economy through both investment on the one hand and also more demand coming from the unions. And you have Europe as a whole. And for Europe as a whole, these ideas of having some kind of big investment program that would be financed by traditional means, by private-public partnership, and if necessary by project bonds, doesn't seem to me aberrant in the present situation.
Thank you very much.
Thank you very much.